8. Powerful asset classes to build wealth. Turn 100K into millions. Hey everyone, John here. You're watching this video because you're ready to grow your wealth, and that journey starts right now. The first step is understanding a key principle: the difference between assets and liabilities. Assets put money in your pocket, while liabilities take it out. Think of assets as your personal money-making machines, consistently generating income. The more assets you own, the wealthier you become. Today we'll dive into 8 powerful asset classes that the wealthy use to build their fortunes. And if you've ever wondered how to invest $100,000 smartly, keep watching because I'll break down a strategy that could turn that sum into something truly extraordinary, potentially even millions. Cash is king. Why you need liquidity to build wealth. Now you might be thinking, cash? Isn't that losing value with inflation? And you'd be right. Holding large sums of cash in a low-yield savings account isn't ideal. But cash flow is crucial. Think of it like this. Imagine a friend approaches you with a once-in-a-lifetime investment opportunity. Maybe it's a startup that's about to explode or a real estate deal that's too good to pass up. You need cash on hand to jump on these opportunities. That's why even companies like Apple, sitting on over $150 billion in cash reserves, understand the importance of liquidity. They can pivot, invest, and seize opportunities whenever they arise. Now, I'm not saying to hoard cash under your mattress. Instead, consider options like high-yield savings accounts, money market accounts, or even short-term bonds. These options offer a bit more return while keeping your money accessible. Peer-to-peer lending platforms are another avenue, often yielding higher interest rates than traditional savings accounts. Remember, cash isn't about getting rich quick. It's about having the financial flexibility to capitalize on opportunities when they present themselves. Real estate, the foundation of wealth. Let's face it, they're not making more land, and that's why real estate has been a cornerstone of wealth creation for centuries. Think about it. Owning rental properties is like having your own personal ATM, spitting out cash flow every single month. And as property values appreciate over time, you're building equity and growing your net worth. Now, real estate investing isn't passive income. It requires research, due diligence, and understanding your risk tolerance. Are you comfortable with the hands-on approach of being a landlord, or do you prefer the more passive role of a limited partner in a real estate syndication? There are so many ways to invest in real estate, from single-family homes to multi-family apartments, commercial properties, and even land development. The key is finding what aligns with your goals and financial situation. But remember, real estate is a long-term game. It's about building a portfolio of income-generating properties that appreciate over time, creating lasting wealth for you and future generations. Bonds, the tortoise in the race to wealth. Now, let's talk about bonds, the more conservative player in the investment world. Think of bonds as IOUs issued by governments or corporations. You lend them money, and in return, they promise to pay you back with interest over a set period. While bonds might not offer the explosive growth potential of stocks, they provide something equally valuable: stability. In the world of investing, slow and steady often wins the race, and bonds are the tortoise, delivering consistent, predictable returns. With an average annual yield of around 3%, bonds provide a steady stream of income, making them ideal for risk-averse investors or those nearing retirement. And here's the thing about those seemingly modest returns: they compound over time. Imagine reinvesting those interest payments year after year. That's the power of compounding, turning small, consistent gains into significant wealth over the long haul. So, while bonds might not be the flashiest investment, they play a crucial role in a well-diversified portfolio, providing stability and consistent returns. Chapter 4. Stocks. Owning a piece of the pie. When you buy a stock, you're buying a piece of ownership in a company. You're becoming a part owner in businesses with the potential to innovate and grow. And as a shareholder, you get to participate in that success. The stock market can be volatile in the short term, but over the long term, it has delivered an average return of around 10% per year. That's the power of investing in companies changing the world, like Apple and Amazon, and healthcare innovators like Johnson & Johnson and Pfizer. Chapter 5. Equipment. The tools of your trade. Now, let's move beyond traditional financial assets and talk about equipment. You might not think of equipment as an asset class, but if it helps you generate income, it absolutely is. For a programmer, it might be a high-powered laptop and software. For a photographer, it's a top-of-the-line camera and editing equipment. And for a contractor, it's the tools and machinery that allow them to get the job done. The key here is that the equipment is directly tied to your ability to earn income. It's an investment in your productivity and earning potential. By investing in quality equipment, you're not just making your work easier, you're potentially increasing your output and earning capacity. Think about it. A chef with high-quality knives can work more efficiently and produce better results than a chef with dull, inadequate tools. The same principle applies to any profession. Investing in the right equipment can be a game changer, allowing you to work smarter, not harder, and ultimately boost your income. Have you ever had a million-dollar idea? Well, intellectual property is how you protect and monetize those brilliant ideas. Think of patents, trademarks, and copyrights as the legal guardians of your creativity, ensuring that you reap the financial rewards of your ingenuity. A patent, for example, grants you exclusive rights to an invention, preventing others from making, using, or selling your creation without your permission. Take the Slinky toy, for instance. That simple yet ingenious design generated billions of dollars for its creators, all thanks to patent protection. Trademarks, on the other hand, protect your brand identity. Think of the iconic Nike swoosh or the Apple logo. These symbols represent not just products, but also a brand's reputation, quality, and consumer trust. That recognition translates into brand loyalty and ultimately, revenue. And then there are copyrights, which protect original works of authorship, such as books, music, and software. Copyright ensures that creators are fairly compensated for their work, encouraging continued innovation and creativity. So, whether you're an inventor, an artist, or an entrepreneur, understanding and protecting your intellectual property is crucial for safeguarding your ideas and turning them into valuable assets. Let's talk about an investment strategy to grow your portfolio over time. We're diving into the Fidelity MSCI Consumer Staples Index ETF, ticker symbol FSTA. This ETF is a diversified portfolio of consumer staples companies. Think Procter & Gamble, Costco, and Coca-Cola, essential goods producers. FSTA focuses on stability and income generation. With a dividend yield of 2.39%, it provides steady passive income. Historically, $100,000 in FSTA could grow significantly over time. Looking for growth to complement FSTA? Consider the Fidelity MSCI Consumer Discretionary Index ETF, ticker symbol FDIS. This ETF focuses on companies thriving when the economy is booming. Think Amazon, Tesla, and Home Depot, companies that benefit from confident consumers. FDIS captures the growth potential of consumer spending. Strong economy? These companies outperform, and FDIS lets you join that growth. Historically, $100K in FDIS could grow to $3.1 million over 30 years. Note, FDIS is more volatile than FSTA. Economic downturns impact consumer discretionary spending. So there you have it, 8 powerful asset classes that can help you build lasting wealth. By diversifying your assets, whether through cash, real estate, bonds, or stocks, you can steadily build your financial fortress. A combination of stable, income-generating assets like bonds and real estate, along with high-growth opportunities in tech and healthcare stocks, offers the best path to long-term wealth. Whether you start with $10,000 or $100,000, the key is strategic investment in assets that grow over time, allowing you to achieve financial freedom.